Happy Memorial Day for all of you. Memorial Day weekend. Today is Sunday, the day before Memorial Day. And for all of you that served, I want to thank you for your service. I'm a fellow veteran as well, joined the Navy right out of high school. So thank you for serving, for all of those of you who served. So just want to do a quick Bitcoin cryptocurrency market update on this Sunday. A lot of people were expecting a big sell-off this weekend, but don't forget that the banks and trading arms are closed tomorrow. So tomorrow could be a moving day, a pivotal day for cryptocurrencies, Bitcoin, those things. Right now, Bitcoin's been kind of bouncing around this weekend between the 33, 34, and 36 price range. Ethereum's been up and down a little bit in that 23, 22, 23, $2,400 range. Altcoins have been up and down. Saturday, there was a lot of selling in the altcoins. Today, they're up a little bit. So that is one of your signs of institutional involvement. So I made another video talking about the pros and the institutional involvement in the game. And that's kind of what I want to talk about today, is that very thing. A lot of people are excited about the institutions getting in the game and institutional adoption, but understand what that means. The institutions have been in the game, institutional investors, professional traders, the people that do this for a living. Now, I'm not a trader. I am an investor. And what I do is I get my information from the top technical analysts out there that have been in the game for years and years and years with stocks and been watching and charting cryptocurrencies since the beginning. So that's where I get all my information from. So I take their technical analysis. I look at a bunch of different factors. I look at the broad macro view of all the markets, including real estate, the housing market, financial markets, all of the exchanges, commodities. I look at everything, and I'm a swing trader. I'm an opportunistic investor. So I like to trade and I like to invest with the momentum. And one of the things I always talk about is you want to lead the market up, lead the market down. That's trading with momentum. And it doesn't matter what you're doing. If you're investing in businesses, companies, stocks, equities, cryptocurrencies, real estate, you want to trade with the momentum, and momentum is more important than anything else. Momentum in the markets is huge, and that's what you want to look at. And that's a lot of what the technical analysis is all about. And you got to understand what these institutions, technicians, the professionals are doing. There's a lot of talk about the wick-off distribution and whether or not that's what's playing out in the market. And if that's the case, what you got to understand is that the professional traders, the real pros, the institutions have been in the market since way back before the big March sell-off that we had. They were in the game back in 2016, 2017, and you see a lot of the peaks and valleys driven by a lot of that institutional involvement. Then we had the big March sell-off in 2020. And in a wick-off distribution, you have to have an accumulation phase. So what is the accumulation phase? That's buying low. That's the opportunistic play of buying low so that you can sell high. So the accumulation phase primarily takes place at the bottom here along this March 2020 timeframe through the beginning of the big parabolic bull move that we had from basically around, it looks like it started moving in the uptrend around July of 2020. That's your 10,000 range. So that's when you could argue that the bull market began. You could say it began, after that March sell-off, and it started moving up, but there was still a little bit of uncertainty there. But that's when the money started flowing. You have to remember, a lot of these banks, a lot of these institutions were given a lot of money and were able to borrow a lot of money, like Michael Saylor with MicroStrategy, issue corporate bonds so that you can buy cryptocurrencies. So a lot of that started after that March sell-off, when the institutions and the markets were flooded with liquidity to put to work. So a lot of the investment banks have put together trading desks. So what you have to understand is what you're dealing with and what you're competing with in the market, and what's driving the markets now are the professional and the institutional traders, and they're trading on behalf of their clients. So they're not trading their own money. So they're very unemotional, they're very technical, and they're very strategic. And a wick-off distribution model is very technical and very strategic in how it plays out. So this phase back here, this May, March, April, May through the September, October timeframe of 2020, that's your accumulation phase. That's when it was down around, anywhere from about 6,000 to 10 to 12,000. And then we start moving up a little bit, and they can still accumulate a little bit along this area here, from basically September through probably November, maybe, and yeah, probably through September, October. And then they're in what's called the markup phase right in here. So as that parabolic move goes up, they're selling into the momentum. Remember, professionals trade with the momentum. They sell into the rise, they sell into the bull market, and they sell down, going into the bear market. So they're trading up, they're trading down, they're leading the market up, leading the market down. You sell into the momentum going up or going down. So as they're going up here, they're kind of watching the market go up a little bit, releasing a little bit of holdings. And then you get across the top where there's broad distribution right here. So this is where the distribution happens. This is where all of this accumulation down here gets marked up through this cycle and distributed at the top. Buy low, sell high. And then what happens is, along this area here, as you're going down, that's your marked down phase. So you've distributed across the top and you've marked down. So the next phase that occurs in the Wyckoff distribution is another little accumulation phase. And then you'll have another leg down before you get that little spring and you bounce back. So we're kind of in this phase here. And, there's an old saying in the markets that how you get up the mountain is the same way you come down the mountain. You come down the mountain the same way you went up. And you see this little accumulation pattern here, this little fake out that we're having, if you will, kind of resembles this little area here where it went up to a little peak, sold off a little bit, went up, sold off a little bit, kind of people were wondering what was going on. That was setting everybody up, that bear trap, so that they could go off to the peak and distribute across the top. So when you get down here, the opposite happens. This is where the bull trap could be set. Sounds like a bunch of bull trap to me. So this is where your bull trap could be set right here. Now, here's what's interesting. So this is like a chess match. You're playing against professional traders, professional technicians that fully understand the psychology of the markets, that have been at it for years and years and years. And their number one job is to extract the most profit possible out of the markets. That's what their job is. It's not personal. They're just trying to generate as much profit as they possibly can. So how do they do that? So they get the retail investor, the inexperienced traders and investors, second guessing themselves, confused, doubting, and things like that. So if you watch the sentiment in the markets out there, people are confused right now. They don't know if it's going to go up. They don't know if it's going to go down. And again, a lot of times, how do you get down the mountain? The same way you came up. So the question is, where is this distribution markdown phase going to end? And what are people thinking? So the trader's goal, it's like you're playing chess. They're always 3 or 4 or 5 or 6 or even 12 moves ahead of you. And you have to remember, these institutional investors, they have serious capital. So they could even buy at 60-something thousand with all intentions of selling the market down. Most likely they accumulated here before we got up to 20,000, but they could probably accumulate all the way up to that range. They'll dollar cost average up here so that they can mark down through here. So they're not using their own money, and they're playing a long game. So they will utilize, if you think about like a value investment, they'll utilize some capital along the way to drop the market down as far as they can get it so they can really accumulate, and then bam, you're going to be off to the races again. So remember, you have accumulation pre-boom, you have your markup phase, you have your distribution across the top where they rake in the capital to drive the market down again, to reaccumulate, and then ultimately go down with that last leg down. So there is still a leg down here. Now, here's the interesting thing. When you start thinking about what they're trying to do, they're trying to get you to second guess. They're trying to confuse you. They're trying to get you to do the opposite of what you really think you should be doing. And, there's still a lot of sentiment out there that we're still in the bull market, that this is just a little correction phase and we're going to hit 100,000 before the end of the year. So there's a lot of consensus around that. Even people that feel like we're in a bear phase right now, feel like they're still going to hit 100,000 before the end of the year. So right now, most people are thinking that's what's going to happen. So if you're on the other side of that trade, what are you going to do? You're going to want to convince people that that's what's happening. So everybody's kind of convinced that maybe there's going to be a little bit of a fake out here with a little bounce. And then it goes down to that 30,000 level again, where there's a lot of support. And remember, they want you to think that what you're doing is right and fake you out. So if there's a lot of support at that 30,000 level, that's engineered. That's to get people to believe that it's not going to go below 30,000 or it's not going to go below 20,000. So those moves are engineered there. So if you get that little spring and that little bounce, then there's every possibility that it could shoot straight down and get you right back where we started to that $10,000 level. And that's all a big setup to get that. Now, how long are we going to hover around this area? So the other technique that they use is they wear people out, right? So they know that the inexperienced traders, retail investors, a lot of them, now I'm not talking about long-term holders. There's the group that just, they bought wherever they bought back here, and they're just going to hold on forever and it doesn't matter. And they're not concerned about it. But if you're trading and you're swing trading or you're day trading, this is where they wear you out. They sit here and they bounce around in this range and they get your emotions going all over the place. One day it's up, next day it's down, and people are watching it right now. If we go back and you kind of look at it right now, it's been bouncing around in that 33 to 36,000 range. And if you watch the comments and the sentiment out there, people are going nuts. What's it going to do? It's going up, it's pumping, it's going down, it's selling off. So this is orchestrated. These are technical, strategic moves, just like they're playing chess, to get you to think something. So right now the sentiment is we're going to spring around here and then it's just going to bounce off. That's what a good bulk of the people think. There's one or two or three people out there that will tell you that it's going to shoot down a little bit lower in that 20,000 range, possibly below, depending on what levels it hits. There is a chance that it could just boom, just go straight down and we don't get that bounce. But again, most of the times, patterns in the markets, you get up the hill, you get down the hill the same way you came up the hill. So we're bouncing around right here. We can bounce around over here. You could get that little spring and then boom, right back down to the bottom. So we could bounce around here, kind of, wears people out, exasperates people. They're trying to figure out how many people they can shake out right here. It goes back up to the top. They get people to buy back in, and then wham, it goes down and they start dropping everybody back down so they can go back into that reaccumulation phase. And then you're back off to the races. And if you go back and don't look at just Bitcoin, because again, these are now professional institutional talent that have been at this for years, that study these models, that study psychology of the markets. They've been through it. A lot of them have lost their entire books and have made it all back. So we're talking about people that have unlimited resources. They're not trading their own money, and it's a game to them. It's chess. So in chess, what are you doing? You're staying ahead of your opponent. You're trying to make them move in certain directions by moves that you're making. So if you look at it from that standpoint, it takes the emotion out of the game, and then you can start anticipating the unexpected. And right now, they're trying to make people think that it's going to do certain things in certain ways. So what you have to do is you have to try to anticipate, what does everybody really think is going to happen? And if you were on the other side of that trade, what would you do to try to make people think something to go in the opposite direction? So this time period here where we were talking about the shakeout phase, January through, it's about a 30-day period right there, for about a month. We've only been in this for a few days. So we've got a little bit more time to go here before we get the big move, but it could just go bam and just start shooting straight down. That would really fake a lot of people out, but it's not going to shoot straight up. That's something that more than likely won't happen. And if it does, that's where your bull trap hits. It could go up to 48,000. What's this level over here? Right here, we're at 40,000 right over here, and the low was in the 30s. That's the same range as we're kind of looking at and bouncing around here. So that's your bull trap area over here. So just watch out for that. Be careful and just be prepared. What are you going to do? So you want to make sure that you have your plan, that it's strategic, that you put it down, and you know what your moves are going to be. If it gets up to 40, you know what your moves are going to be at 30, 20, and 10. And, there's a lot of talk out there about hitting 100,000 by the end of the year. And if you fully believe it can hit 100,000 by the end of the year, then you have to fully believe it can hit 10,000 as well before it even gets there. So everything is on the table with Bitcoin right now, the way these markets are, especially now that it has the attention of all the institutions. Remember, they are trading technically, strategically, and they are trying to move the market and trying to get people to do the opposite of what they really should be doing. And if you pay attention to what's going on out there, one of the ways they do it is by wearing people out. And it's been done over and over and over in the markets. And remember, you always want to trade with the momentum, and you always want to move with the markets. You don't want to go against it. You don't want to try to time the tops and the bottoms. You want to go with the momentum of the market. Momentum is 100% of the game. So study the history of this, go back and look at it, especially from 2017 on. That's when the institutions really started getting a hold of this and getting involved, at least the traders, maybe not the institutions themselves. And when I say institutions, you have your companies and your corporations and individuals like Michael Saylor. That's not really institutional. That's one individual, doing their own thing. So that's not really like an institutional investor. Your institutions are going to be more like the clients of the JP Morgans, Goldman Sachs, companies like that, Morgan Stanley's. They put trading desks together. So again, it's not their capital, it's their investors' capital, because their investors are wanting exposure to all this action because they see the big gains, they see the big jumps and the big moves. So the institutional involvement is going to calm some of that down, and it's going to slow the pace down, because again, their whole mission in life is to extract as much profit as possible out of the markets. And the institutions aren't going to come in when you start getting into sovereign wealth funds, life insurance companies, hedge funds, equity funds, companies like that that are investing their clients' money. They're not going to pay ridiculous prices for an asset. Their goal right now is to try to get those assets at the best price possible for entry, and then mark those assets up again. So they have to accumulate, mark it up, and distribute. And that's a lot of ways that those things are done. And there's many versions of that all the way along. So if you drill down into these markets, you can kind of see a mini version of that going along, which is kind of where we're at right here. So just be aware of that, watch the momentum, and just have a plan in place for what you're going to do up and down, and understand again what you're dealing with. You're dealing with a chess match. This is designed to get you to move in a certain direction, to get you to think in a certain way, and then go the actual opposite of what you really should be doing. And at the end of the day, question yourself and confuse you. And if you notice what's going on out there, there's a lot of confusion out there about this right now, because that's exactly what it's designed to do, is to confuse you. So go take a look at the stock markets, Dow Jones, kind of look back at some boom, up and down cycles there. And you'll see what I'm talking about, that, a lot of times you come down the mountain the same way you went up it. You can look at it in the S&P, you can look at it in the Dow Jones, and, not just the big cycles, but look at the little mini booms and sell-offs in those markets, and kind of pay attention to the patterns and how it works. And make sure you're careful who you get your information from. There's a lot of people out there. One day they're talking about $350,000 by the end of the year. The next day they're talking about, selling off and things like that. So just make sure that you're getting good, consistent information from an objective standpoint, that's kind of showing you the real technical analysis, the kind of people that I rely on that have been in the game for a long time, more than 10 years doing this, watching different market cycles, different peaks, and they've been in the Bitcoin markets all along. They've been paying attention to it ever since the beginning, and watching it go up and down. Now it's something that has a lot more attention, a lot more patient capital. Remember, the institutional money, be careful what you wish for. It is patient capital. They have unlimited resources to manipulate price. And when I say manipulate, what I mean is strategically drive the price of that asset up or down. They can buy high to drive it down low, and then reaccumulate, because they're playing the long game. And it's all about ROI and velocity of cash. They're also getting in and out along the way. So they have the ability to do that for those outfits. It's just a matter of putting capital to work. And the end of the day, they have an IRR that they're looking to hit over a 3, 5, 7, 10-year investment cycle. So it's fascinating times we're into. Monday, Memorial Day, could be a big day. That could be the day that we see some movement and price action in Bitcoin, which again affects the entire market. Pay attention to how that's working. One day the alts are up, the next day they're down. One day Bitcoin's been kind of level, but the altcoins have been kind of up and down, especially Ether as well, on bigger moves, 15, 20% moves up one day, 15, 20% move down the next day. So if you know what you're doing, you can kind of work those and play those a little bit, but you got to be careful. Make sure you know what you're doing, what you're getting into. Limit your orders so that you don't pay too much, and you got to put your stops in so that you don't lose out if you're not paying attention on that trade. So a lot of ways to do it. Just trade that momentum, keep an eye on things, watch for the patterns, and understand this is a chess match. If you're in a chess match with the market right now, and the institutional investors driving these technical strategies and moves in the market, what are they trying to get you to do, and how can you play that move so that you're 4 or 5 or 6 or 7 steps ahead of them? So that's what you want to look at. Have a happy Memorial Day. I'll see you on the next video.